Good morning, everybody. It is Tuesday, May 18th, 2021, the day after the AT&T deal. I'm going to show you why you want to get involved in this and how to do it. So, if you didn't already own AT&T, you need to get it. I went through all the reasons yesterday in the Stocks of the Week. I made that public, so go ahead and take a look at that. But I just want to really emphasize to you that you want a part of the new company that's coming out of this. Let's take a look at AT&T. This is where it was before the Time Warner deal. Rumors of the Time Warner deal falls. Comes back, chopped all the way down, gets a little bit of relief rally during the repo market bailout. But really, this has been the price range, right? For a couple of years, just had that rally here, fell off a cliff for COVID, which didn't really make any sense given what type of company this is. But now it's chopping around. And you have what I would call the dividences. You look at the message boards. Hey, they're going to cut my dividend. They're going to cut my dividend. Well, you know what? So what? Seriously, so what? All these people who chase yield at the expense of quality are just, they're what I'm calling them. They're dividences. They just don't understand what they're doing in any way. They say, oh, look, 7%, I'll buy it. Rather than, hey, look, a company that's cutting the step by a quarter, basically going to pay for the rest of its 5G build out with this, and it's going to have pricing power. And by the way, if you really knew your company, you'd understand the reason they still have Xandr at the moment is so that they can become a platform company and compete with Roku and Amazon Prime, because they're certainly going to still have access to Time Warner and Discovery content. So you have all the dividences saying, oh man, in a year they're going to cut my dividend. And they're selling it today. Because the dividences don't realize, hey, this new streaming company, this new content company coming out of this is going to be hugely valuable. What other deal just got announced was likely to happen yesterday? Remember I told you that MGM Studios was for sale? Who's buying that? Hey, it's the company that I said should buy it. Amazon. These content companies are wildly popular, wildly profitable. The libraries are super valuable. So the idea that you would sell AT&T because your quarterly dividend will go down 40% is penny wise and pound foolish. First off, if you're hunting for 7 and 8 and 9 and 10% dividends, you're a moron. You really shouldn't be handling your own money, because there's nothing with a dividend that high, nothing, zero, not a single one, that isn't a huge risk of losing in a share price. Not a one. Not the REITs, none of them. You saw what happened to Simon Property and dozens and dozens of other REITs. The price that a lot of things went down to last year were about fair value. And the idea that the government's going to prop them up forever is idiotic, because the government can't afford to do it forever. You've got the president of the United States telling you that we're going to shift over to fiscal policy away from monetary. I don't know how much more clear it can be. The sugar high will end eventually. And when it does, there'll be a great bifurcation in the market where the new thing will be profitability. So you have to be in companies with pricing power. Because this inflation that we're seeing right now is a one-year thing. Maybe it's 18 months. I don't know. Maybe it's 6 months. But all it is are the comparisons from 1 year prior and the readjustment of supply chains. Tell me something on the planet that is truly in shortage, something that we can't get more of given just a little bit of time. What are the basic laws of economics? If it's highly profitable, has good margins, what does it attract? Competition. So unless the government says no, everything gets competition. There's no shortage of food. There's no shortage of energy. Those are two of the most important things out there. There's really no shortage of water. You notice that Biden's plan has huge water spending in it. For whatever reason, the Republicans are opposing that. What did I tell you a year or two ago? 3 years ago, probably 3 years ago, I think. The rebuilding water infrastructure is probably the most important thing on the planet. And there's a lot of it to rebuild. There's no shortage of work. In fact, we're going to need more robots doing more things. because there is no shortage of work. That's why I like a lot of the platform companies in the AI and robotic spaces. There's going to end up being a AI dividend in the future. What do I mean by that? I mean that wages are going to go up and the hours that you have to work are going to go down. And while some people like me would like to be worth 8 figures or 9 figures someday, I mean, I'd be lucky to get to 9. A lot of people don't think like that. A lot of people think, I want to make enough money to pay my bills and have some fun. And that's fine. I like to pay my bills and have fun too, but I like an extra zero. Why? I got things that I think I want to do. I want to be a part of rebuilding Milwaukee, maybe another place. I want to make sure that if I have a grandson or granddaughter, niece or nephew that says, hey, I have a great business idea, but I need $100,000 to get started. Well, I know that the hardest thing out there is getting started. They always say making your first million is the hardest. It is. So when you think about companies that you want to invest in, think about it like a business person. Think about it in the scope of the reality of society, where 4 out of 5 people just want to get by. Now, they want to get by better than they've been getting by, because there's been a breakdown in the middle class for the last 40 years in America, while the rest of the world started to catch up. And Americans in the last decade, I'd say, since the financial crisis, a little longer, they don't really understand why things happen because they're not economic students. They don't study history, right? I mean, they might know the lineup of their favorite baseball team from 20 years ago, but ask them about anything to do with economics, and they're gonna be like, I don't know, man. So what is AT&T going to capitalize on here? They're going to be one of the 4 giant players in 5G, and for at least the next 5 years, one of the 3. Because Dish isn't going to have their network built for quite a while, and they're going to absorb a couple of the regionals anyway. I think AT&T, now that it has basically recommitted to communications and is hinting at being a platform company, right? Because honestly, is Roku's technology special? It's not special. AT&T can put that right on their wire, right? You remember the channel guide? Why can't they have a streaming guide? Have an AT&T home screen that says, hey, what apps do you want? Subscribe here. They control the wire into your house. That's a big deal. And you're always going to need that wire in your house because your cell phone speed indoors, isn't fast enough. You need the 400 megabytes, so you need the gigabyte speed when you have 10 devices on your system. So you want AT&T for 2 reasons. One, it's still going to pay a better than market dividend. It's going to start buying shares back in 2023. Its debt is much lower now. The average maturity on its debt is 16 years at 3.6%, 3.8%, one or the other, I forget. And they have pricing power. And pretty sure they're going to be successful as a platform company because, again, not a big barrier to entry, and they got the wire in your house already. So while I love the concept of Roku, the idea that Amazon and AT&T and Google and Apple can't compete with Roku, it's just silly. AT&T, Amazon have a more open platform, and the cable companies can probably do it too. So this idea that Roku is a walled garden is wrong. It actually makes sense that Roku would sell themselves to somebody. I think Amazon makes the most sense there, but Google could be it too. But with Amazon buying MGM, now they're gonna have a bigger content library. What did I talk about yesterday? I think NBC, I think they're probably for sale. So then that can just become a cable company again, Comcast. They can merge with, just all sorts of little bitty cable companies. There's like some obscene number of cable companies in America. It's over 1,000. They're little too. So you got these big ones that serve as the backbone. But here, AT&T, by the way, is either the second, I may be first in fiber deployment. Fiber is a big deal. They're deploying it in where I live now. They're putting it throughout Franklin, Wisconsin. And I am exactly 5 blocks away from the fiber right now. But it does run down the giant street that I'm a half a block away from. So that means they're going to start running those wires off the big street. especially into the condo complexes, because that's easy. AT&T's fiber numbers are going to go up dramatically. High single digits, they say. I think they'll beat that number. I also think that if the satellites in the sky work, they're going to crush their mobile numbers too. And I'm sure they're going to have some sort of a deal with the content. Get AT&T sell the fiber and get the HBO Max or Discovery Plus bundle for cheap, maybe half price. Plus, they'll have a giant sale at the back end, right? So they'll have a sale of free probably through the end of the year. Get it for a year for free or for $1 a month or something. I would do $1 a month just so people are used to paying for it. Then you bump it to $9.99, then you bump it to $14.99, then you bump it to $19.99. So if you took a look at AT&T today, you notice that it opened down, and now it's starting to bounce back up a bit, right? You had all your sellers at the open, your dividends. Now it's starting to catch a bid. Look at that. I'm not saying this will happen, but it wouldn't surprise me if it made back half to 2/3 of the drop from the open by the end of the day. That's 5 hours, 4.5 hours. Use the volatility right now. Log into your computer right now. Now, sell some cash secured puts on this. I've been selling the September $30 cash secured puts this morning. Got $2 for them. I think they're about the same right now. Let's take a look. We're a little bit below that now. Go and sell these right now. Right now. Go sell them right now. Click, click, click. Because you want a piece of what Discovery becomes. It's global. It's everywhere. More people watch Discovery channels than any other group of media in the world. With this added content, they're going to crush it in all these places. When you take a look at the debt, you say, okay, they have a little bit of debt. They do, but it's well structured, and they're going to save $3 billion a year in expenses by merging, at least for the first several years. I'd like you to compare AT&T to Netflix. Blue line is Netflix last 5 years. Red line is AT&T. You think the new company is going to be able to fill that gap? So what if AT&T stays flat? I don't think it will. I think AT&T is going to either get back to its 5-year highs, so 40-ish, or it's going to break through there and head up to 60-ish. We'll see. The main thing is you want to own this stock when they spin off Discovery or when they do the Discovery deal is final. You want those shares. Big dividend. They're giving you 71% of a company as a dividend. You can always just turn around and sell it, right? Discovery Warner Discovery, whatever they call it, is going to fill this gap. Maybe not all the way, maybe only this much, maybe up to here. But I'm pretty confident in their content package. And I really like the Discovery people running this. And John Malone's still going to be an 8 or 9% owner. Right. Take a look at a couple others. You don't really want to buy the Discovery, by the way. You want the bigger hunk. So buy the AT&T. I'm not saying you can't own Discovery. I own that too. But AT&T, I think, is a better way of arbitraging this deal. So on run, we've talked about flows, right? Money flows almost oversold. RSI is almost oversold. Give it another week, maybe. I think that next dive is going to be the one. On track, it's just beautiful, right? That's just beautiful. You should be pounding the puts on this one every time you get a chance. Paycom. Look at that. It's starting to move sideways right along our line. Is that crazy? It's like our charts are okay. So weird, right? So Paycom we might be close to. I think you could sell puts on these too, but it's a huge number, right? So might just have to start super slowly nibbling shares, in case it takes one more digger. But L, there you go. Leveling off right in our buy zone. I'm going to sell some of these puts today, I think. We'll see. We got a couple out there. I don't know if I want more. Check the accounts. But if you haven't sold any of these, I think go ahead and sell these. The 100s, 110s, whatever you want. It just depends on how much you want the stock put to you. AST, Space Mobile. Take a look at that. Look at, Start your sideways jitterbug. Start making these neat little triangles. Oversold on the money flow index, almost there on relative strength index. So the money flow index is definitely pulling this down a little further, but it doesn't mean the price has to do much anymore. Take a look at your MACD, right? That should turn up in here somewhere. If you think you're gonna get some sideways, that's why you get the sideways motion in the price for a while, because it's doing this. Yeah, I accidentally have a full position in a AST Space Mobile. I didn't mean it, but I averaged down. So there's that. I mean, I think you're probably healthier with a 2% position than a 4% position, unless you really want to speculate on something that could be a 20 or 30 bagger. Because if their technology works, this company literally goes to the moon. So if the puts get put to me on track, I'll have a full position in that. It'll be between 3 and 4%. That's why you always should break up your accumulation into 3 pieces, and if you only get 2 of them done, that's okay. You know, in my case with AST Space Mobile, I'm almost certainly going to get the $10 puts put to me. So my accumulation ended up being faster than I would have liked. But again, there's a lot of people out there who don't want to speculate on whether or not this technology works. I'll just tell you, it's a question of telemetry. If you do the reading, you realize it all works if they can get the signal to be stable. And it seems like they can do it. Everything tests out that it should work. But, right, you don't know until you know. They got a big pile of cash there. So the funny thing is even if they threw in the towel, if they said, I give up, I mean, literally, they could just return cash to shareholders and a giant special dividend. They won't do that because I'm pretty sure this is going to work. I mean, take a look at the partners for these guys. I mean, just take a look at their partners. Go to their page and look. It is amazing who's behind this, right? So I'm going to keep this one short today. And here, sell puts on AT&T. If my last batch of puts get put to me on AT&T, I would have a double position in it. Full 8%, maybe like 8. It might even be 9% of my portfolios. Why? There's just not very much downside. And you got huge potential upside. And I really want those Warner Discovery shares. So there's just not a lot of stocks to do this. If you get a chance to even get half of this, right? It closes the gap halfway with the other stock. And then just, even if this one keeps churning along, right? I'm not saying you won't sell AT&T in a year or two, but what's the whole concept of owning a dividend stock? What's the right way and what's the wrong way? The wrong way is to be a dividends. To say, I need my 7% dividend, my 8% dividend. There's a newsletter writer who tells me that he can have a 10% dividend portfolio. Right. That guy who's got a giant service on Seeking Alpha, his portfolios were down like 60% last spring. Government saved him. He's not smart. He's not even an analyst. Just some banker. Wrote a bull market in bonds. Big freaking deal, right? Somebody on here right now is mentioning the guy. Very badly hurt. I don't mention the name because that's not nice. But anybody in their right mind who thinks that 8 and 9 and 10% dividend yields are safe has no idea what they're looking at when they look at a balance sheet and isn't thinking remotely about the quality of the business. The only reason some of the REITs throw out those big dividends is because they're backing out sales, or they're riding a bond bull market, which is rapidly becoming an extremely neutral market. Could even be bad. I don't think it will be really bad. I've told you I don't think the 10-year gets much above 3%. It'll be between 2 and 3%. That's going to be the new normal. And it's still going to head down towards 1% at least one more time, because deflation is the big boogeyman, not inflation. So, right, REITs have a special tax status. They're passing over all that free cash flow. So when the rents aren't as good, or CapEx pops up, or interest rates change, they can have a big problem. BDCs, you have to rely on them to run a really good private equity firm or venture capital, right? BDCs are hard to invest in because it's really truly not an income investment. It's truly a growth investment. You're betting on the companies that they own to do well without really having a lot of transparency. So I've never really got heavy into BDCs. A couple times with some of the tech ones earlier, like in my career, but the BDCs aren't very transparent. If you are an accredited investor, you're better off doing different things. And if you're not an accredited investor and you can't get into private equity investments, you're probably usually just better off skipping it, or maybe buying some listed private equity. Ignore the dividend. Think about the underlying quality of the company. Will they really truly achieve growth? Because all they're doing with the BDC is when they sell a company, they distribute the money. So they better be good at growing little companies. Business development companies are BDC, business development company. So in any case, theory with AT&T, very simply put, go all the way back to we'll finish where we started, is that the spin-off company is worth something between here and here. There, you're getting a company as a big fat dividend. After the company dividend is paid out next year, you'll have to reassess. Do you believe that AT&T is capitalizing on the reduced debt and the pricing power from 5G? And especially as cars, right? All the cars made by 2025, whether they're EV or not, are going to be connected to the internet with either level 2 driving or higher. I think most of us will have level 2 driving, so super duper driver assist. Almost nobody's going to have level 4 driving unless you're doing it in a geofenced area. Regardless, the cars are all going to be attached to the internet, and that's good for AT&T. All right, have a wonderful rest of the day, and I will get some things published here before I head out to the doctor, or maybe tonight, but they're coming. And the AT&T article is getting big, so I got to pare it down. It's probably going to be in 2 articles. I'll probably write something called Don't Be a Dividends, because there's just so many people chasing yield right now. Chase quality, chase upside. All right, take care.